Happy Friday. Hope you are having a great week. Here we are 2 days post Fed rate cut, and we're seeing a very similar story from last year. So last year, mortgage rates improved from June through September, just like they did this year. Fed did their first rate cut in September last year, and mortgage rates kind of held steady until the beginning of October. And then from October 1st through October 31st, we saw rates go from 6% to 7% on a 30-year fix. Now this year, Fed has done a subsequent rate cut, and now mortgage rates are slightly higher here in the next coming days. It's going to be really interesting to see what rates do over the next couple of weeks here. I'll be anxiously watching to see as we head into October, where are rates at? Are we going to see them move higher, or are they going to hold steady? What's really going to drive the market from here forward is the state of the economy. So mortgages get traded on Wall Street as long-term bonds called mortgage-backed securities. So what the long-term bond market does, that directly correlates to mortgage rates, not the Fed funds rate, which is a short-term borrowing rate for banks to borrow money from the Fed overnight. So when the Fed cuts, that directly impacts auto loans, credit cards, short-term loans. When mortgage rates move, that is a result of what's happening in the long-term bond market and specifically mortgage-backed securities. So as we look forward, if the economy slows down, if we see further weakening in the labor market, inflation coming down significantly, we could expect mortgage rates to come down further. If the economy starts to take off, if inflation increases, if the growth is really strong, then we could expect mortgage rates to move higher. So it's going to be a news-driven, data-driven cycle now with mortgage rates over the next couple of months, and it'll be interesting to see how it goes.